A public health crisis like COVID-19 creates a lot of uncertainty, and it's hard to predict what the economy will look like over the next 12 months. That makes it difficult for municipalities and municipal authorities to plan next year's budget. To help them, we're sitting down with a variety of experts to get their advice for building a balanced and resilient budget for 2021. Today, we're talking to Jen Karen, a bond attorney resident in the Harrisburg office of Eckert Siemens. She'll tell us how municipalities and municipal authorities can free up cash flow by restructuring or refinancing their debt. Jen, thanks for joining us today.
Sure, Adrienne, thanks for inviting me.
For some municipalities, debt service can be a sizable portion of the municipal budget. Are there any ways they can get relief from debt service obligations when economic slowdowns put a strain on revenue?
Yes, there are several government subsidized programs such as Penvest and the USDA Rural Utility Service that have offered relief to borrowers with respect to their debt service obligations in light of the pandemic. Penvest has been able to offer borrowers up to 3 months of loan service deferral. Those 3 months would be 3 consecutive months. And although this deferral program has technically expired as of September 1, 2020, we understand from Penvest that they are still accepting deferral requests from borrowers that are in good standing, which was a requirement of their initial deferral program. They are considering these deferral requests on a case-by-case basis until the governor's emergency declaration order has expired. And we understand in speaking with Penvest that they have afforded this deferral opportunity to 32 of its funding recipients, which has impacted 74 of the existing Penvest loans. As you can imagine, some of those funding recipients have more than one Penvest loan outstanding. So when taking advantage of the deferral program, it did impact 74 Penvest loans. Similarly, with the USDA program, they are also addressing deferral requests for existing borrowers, and they too are doing that on a case-by-case basis. They have told us that obviously a need needs to be documented, and they have said that there needs to be a 20% loss in revenues demonstrated for them to even consider a deferral request. And with respect to the water and wastewater program that is offered by USDA, only a handful of deferral requests have been considered on a nationwide level, and to date, thankfully, there have been no requests in Pennsylvania.
What about private lenders? Are they offering similar solutions to help alleviate debt service commitments?
So what we have seen in terms of the private lenders, which would be the banking institutions with respect to bank loans, we have seen clients take advantage of opportunities presented by the banks to either reduce the interest rate that's currently in place for a loan or to restructure their existing debt, whereby some upfront debt service is extended and moved to later maturities, which obviously provides for some debt service relief during this time of crisis, but then it does move the maturities down the road for them to take care of. But the thinking behind this is that hopefully by the time those later maturities would come around, the municipality would be in a better financial position to handle those, and the economy would be on a more secure footing at that time. Obviously, the bond attorney counsel role would be very important in order to make sure that in terms of any refinancing, and particularly with a restructuring where you're extending debt, that both state and federal laws are complied with in terms of those refinancings and restructurings. Obviously, as we're aware, the Local Government Unit Debt Act requires that debt service be existing on an overall level debt service structure. And in terms of the Debt Act, there needs to be financings that are within the useful life of the asset. So in extending any type of debt, you can't extend the debt past the useful life of the asset. So those are some elements that need to be considered from a legal standpoint in terms of those types of opportunities.
Current interest rates have led a number of HRG's clients to refinance existing debt. Can you explain the benefits you're seeing based upon the current financial market?
Sure. So the disclaimer that I'd like to say is that I am certainly not a financial advisor, so I'm only speaking from my bond attorney perspective, but we have been able to see our clients in recent months due to the current economic and financial market take advantage of very low interest rates over the last couple of months. The 10-year treasury rate has been remarkably low and stable over the last several months. And in fact, we've actually seen a lot of banking institutions being willing to fix the interest rate for a longer period of time than usual. And in fact, recently we've actually seen the banks offer close to a 1% interest rate that is fixed for 10 years, which is something that we typically haven't seen lately. Also, during the pandemic, we have seen private lenders being able to agree to extensions on draw periods, which obviously is critical if the draw period needs to be extended based on any type of delay in construction as a result of the pandemic. So we've seen banks offer to extend the draw period to provide additional time for the client to draw under the loan, which again is particularly helpful during the COVID situation. If there is an extension agreed to by the bank, it would be helpful and very important to have bond counsel involved to just document that properly to make sure that any extension is certainly within the realm of the state and federal law requirements.
What other types of borrowings can municipalities consider to help with short-term cash flow needs?
Sure. So as we approach a new budget year, many of you are probably aware of what we refer to as a TRAN, which stands for Tax and Revenue Anticipation Note. And those are a type of borrowing that's permitted under the Debt Act. These TRANs are short-term notes that allow municipalities to borrow up to 85% of their anticipated tax revenue during the current fiscal year or the period in which the note would be outstanding, whichever is shorter. These notes they do need to be repaid during the current fiscal year in which they're issued. So that is the limitation in terms of a TRAN, but it is something that municipalities may want to consider as we're heading towards 2021, which would give them the full fiscal year, the full calendar year to be able to repay that TRAN. There are certain restrictions under the tax code with respect to these TRANs. So if they are being issued on a tax exempt basis, they obviously need to comply with the tax code. And it may be wise for a municipality to explore the difference between a taxable and a tax exempt interest rate on these TRANs to make sure that they're taking advantage of the most flexible way in approaching and incurring this type of debt. But again, these type of debt obligations are helpful in terms of providing working capital funds, which are otherwise not permitted under the Debt Act or the tax code.
It's evident that reevaluating existing debt service obligations and considering new money borrowings are key considerations for public entities as they strive to remain financially strong during these challenging economic times. Jen, thank you for joining us today and providing HRG's clients with valuable insight as they work to establish budgets for the upcoming year.
My pleasure, Adrienne. Thanks again for inviting me.